In our past video, we discussed the Gartley pattern, and in this video, we are going to review some of the other patterns that make up the harmonic patterns. So, if you were to go to your back office, okay, let me just fix my chart here. If you actually go to your back office and you look under, let me just show you. Okay, that would be your site. Under trading, there's a button called harmonics, harmonic patterns. You click on that and that will bring up all the different patterns that you need that we look at for harmonics. You also can download the PDF to your computer and you don't have to always go online. But what we're going to do now is we're going to spend some time going through the harmonic patterns and the thinking behind it and how I like to look at them. All right, but we have to look at the basis, and then what we'll do is, as you see here, I have a chart and we can start drawing out some ideas and get you more information. So this is part of the course. The course is more of an unorthodox course that you would get a canned course anywhere, because I feel these canned courses will just teach you the same exact things over and over, whereas our continuing educational course will bring to light many new ideas for you, and you'll see as time goes on. Okay, so let's look at the Gartley pattern once again, and I'm just going to draw it out. So the Gartley pattern, what we look at for impulse. Okay, we look at impulse. This is an impulsive leg, and then you get your retracement, and then it comes up, and then it comes down again. So let's take a look at a real chart first and understand what impulse is. All right, so let me just open this. Okay, what is impulse? So this is impulse. Okay, you see that? This is impulse. All right, this is impulse. All right, so let's take a look. We have, this would be impulse. So what you're seeing is an impulsive leg in a direction, a trend in a direction. For instance, this is impulse right here. All right, so what you're looking at is the market giving you a definite direction and then starts to form the patterns. So if we were to take, for instance, let's just go through a chart here. Okay, this is impulse down, this is impulse up. You see this? That's all impulse, direction, trend direction. All right, as we continue to scroll around, you'll see it. Now, harmonics are primarily good to use when you're looking at a trend, okay? And they're also good to use in a range. So where you may look at this and say, it doesn't show us much. What I see, if we were to take the Fibonacci and we go from low to high, a couple of things have happened here. So let me show you. Triangle, low, high, and that first retracement. So we actually can come down to here. So we have low, this would be X, A, B. So impulse up and then your retracement down before you've gone higher. Now the retracement up, we look at this separately, where the market would have its swing up, and that means from this swing down to the low back up, and then we have the next leg down. So if we were to look at this and we say shapes, triangle, we have the low, high, down. Now to the average eye you wouldn't see this. Let me just get rid of this Get rid of this. Okay, let me just adjust this to the swing low right there. And let me just adjust this. I'm doing this rough, just off the cuff so you can see it. So the market has its halfway point, 50%. So it went between a 38 and 50% zone. All right, this right here, the 38 to 50% zone. And we'll make this nice and pretty. We'll put a nice color there, okay? So the fact that it went through this 38 to 50% zone, it went up 38 to 88% and then down again to the 886. This created this impulse up, and then you got the retracement, lower, high, down, created what's called the bat pattern. So if we go back and we take a look at our patterns here, okay, we take a look at our patterns, this would be that particular pattern. You see that X to A, down 38 to 50, up 38 to 88%, and then down to around that 886 retracement. So this created that bat pattern. Don't worry about so much of it just yet, but I'm just drawing this out in terms of what you're looking for in terms of patterns. All right. So it's always the impulse leg is important, and then that first retracement. And yes, it had a retracement here, but the market made a lower low before it went up and put that low, higher low, and then down again. So you see how this structure works out. Essentially, if we were to look at this and we were to delete this, delete this, delete this, and delete that, what we would be looking at is this. All right, so if we look at Elliott wave, Elliott wave has these alternate wave equalities. So right here and right here, you see this? They're almost directly the same in length. Swing down, up, down. This is what's called an A to B, C to D relationship. So that's always the primary focus when looking at harmonics. Also, the primary focus is always looking at where X is going to end up. So we look at the impulse up, and then we look at the retracement, and that sets the stage for the future pattern. Okay, what we don't do is this. Okay, we don't do this, this, and then start thinking that the bat pattern is going to happen. All right, I know a lot of traders, they look at it and they think, well, we got this, or they have this. Let me just make this a little thicker so it resembles the other line. A lot of traders will look at it and they look at this and they think, well, that's the pattern. That's what we're looking for. Quite honestly, I don't do that. I know there are traders that and I know that it's taught that once it breaks this point on the way down, you could then play from this point to this point. I don't particularly like that, because if we're looking at this market as a buying opportunity on a retracement down, and how I'm looking at this overall, let me just fix this. What I'm looking at overall is market high. How deep can it come before it wants to turn up? That's what I'm always looking at. How deep can the market go before it turns up? I look at prior swings. I look at all sorts of things. If we take Fibonacci, for instance, we go from here to here, and then we swing it over here. All right, I start looking at where relationships go to prior swings. Right now, it's not important for this particular video, but I know traders like to look at that well in advance. I don't particularly like that. I like to let the market form its pattern, and then right as it's hitting the zone, as it's pushing down, I like to look at it and then think, okay, this is an area. Even when we look at the area, there's still patterns you want to use to enter. You don't just arbitrarily enter the market for a trade. And let me draw this out so at least we're all on the same page. So where this went up on a daily, and of course it looks like it went straight up, but on the smaller time frame, the market hit its point, turned up, and then started pulling back. So this here being this, the market has pulled back. It may have done even something like this on a shorter term time frame and created its own little Gartley pattern or bat pattern. And I look at little retracements down for entries. The other thing I like to do is where you have a zone where the market can enter, the market may pull down under it, then come up, and then down, and then up. And I like to use that little swing high. So let me just erase the screen and do that over again so we're all on the same page. This area right here where the market completes itself, and that's where we're looking for the buying opportunity, I look at little opportunities. So for instance, let's just say this was the low, okay? Let's just say, oh, let me just erase that one more time. Let's say right here, market had pushed into a zone, right? It pushed into a zone. What I like to look is something like this. Market pushes into a zone, okay? Same as you do here. Market's pushing into a zone. I like to let the market react up, come down, all right, put a higher low, and then turn up and start buying here because you want to make sure that the market low is definitely in. You don't want something where you're buying and the market just crashes against you. So where the market goes in the zone, I like to look at something like that. Or, all right, so let's just say the market, sorry about that, guys. Let's just say that this was the entry right here. Market hit, held, all right, does something like this. And it pulls back and it's starting to hold. Right here, as the market starts to turn up, you could buy it here, you could buy it there, because once the low is in, you're confirming that the low is in. You want to see the market swing up. Let me show you one of my favorite patterns of all time. Let's just say this here would identify with this, okay? Same thing, all right? Let's just say that's the same situation. The market runs up, right? And then has its little wave down, all right? Or just a retracement. This is what's called a bull flag, all right? And markets start to turn. You want to see the market stop going down. Most important, you don't want to buy a falling knife. The last thing you need to buy here, it's here, it stops you out. That's not a good feeling. So where you have support, market finds support, you let it bounce off, it shows you that support comes in, and then you're letting it retrace. All right, even if, and I'm doing all this before we look at the patterns because it's real important that when you're looking at patterns that you're looking at the entry points and how you treat them. So we have plenty of time to look at the patterns. Market goes up, market comes down. You're looking for that market to stop, a higher low versus here. Once you got that and it starts to turn up, you can enter to the long side. You're confirming that the low is in because you have a bigger structural pattern right down there. All right, that's one way to look at it. The other way to look at it is let's hypothetically say that right here, okay? Let's just say this was the pattern, okay? Let's just say that's the same price, all right? And actually, let me fix this. I'm going to show you where it makes more sense. Let's say that right there was the entry. That right there was your risk. Right here was your entry. All right, right there is your entry, and your risk is all the way down here. So let's just say hypothetically from here to here, that's the same thing, same price level, okay? Same price level. What I like to look at, you got the market pushing down, pushing down, pushing down. You don't know when it's going to stop. You don't want to buy a falling knife. You want the market to turn up and either A, pull back, give you a spot to enter, risk, or when it turns up, you're entering right above that little swing high. And that's basically telling you that support is in down here. And then once it starts popping, you're good. You're fine. Market rallies. Now, if you're looking at it and you want to wait for a larger time frame, you can look again. The thing is, you want to allow the market to stop going down. So there's many ways to skin a cat. We have a video, PRZ, potential reversal zone, and that's what we're talking about on the website. But this right here is the prelude, is that what they call it, to the future of what we're going to be discussing in our patterns. But those of you who have experience, I really want you to apply the use of these patterns. Okay, so point one, market hits the support, rallies, comes down, shows support, you're buying them. Next thing, market comes deeper than your entry. You don't try to force it. Let it bounce, let it come down. You either buy it here or it turns up and you're buying it right at this point right here and you're securing the lows. When you see the patterns, for instance, let's just say we have this is showing on the chart and that, okay? One is your entry, one is your risk on the scanner, all right? You have a little zone. One is the entry, what is the scanner? That's just a suggested price. Let's just say hypothetically, market had come all the way down here like this, right? Came up, came down, and then came up. All right, this is still valid. Overall, this is still valid because now it's just the fact that the market put a deeper low. The pattern is still valid for you. You could still enter this. All you're doing is looking at this, that the market came a little bit lower than you would expect it. The other thing is we have questions on should it repaint. Okay, so here would be an entry, right? Okay, so let's just say the market, it painted here. And then prices come down a little bit further. And now it painted again. It's supposed to do that. Our scanner is supposed to continue to paint. So when you keep that in mind when you look at the scanner of what we're doing, and that's our scanner right here. It's very nice, isn't it? Look at that. All right, we're going to get into this later on, but those of you who ever have experience, you know how to enter, you know how to trade, you know how to look at patterns. That's you're already ahead of the game. We're discussing this with those that are newer and that are looking at this course. All right, so I just wanted to get into a little bit of what impulse is, what retracements are, what happens when you definitely get down to those zones, and now we're going to start getting a little bit more into the educational side, and we'll complete the video. And the next one we'll have even more information. So let's get back to this page where we were drawing information. And I want to seriously spend a little time, and that way everybody's on the same page when it comes to harmonics. We have so much information to share with you that I don't only look at harmonics, I look at Elliott wave in relation to harmonics. And what we'll do is we're going to look at theory today. I'll draw in, on this particular video, I'll draw in the patterns, and then I'll draw in what happens within those patterns. And you'll see that in a few minutes. All right, I want you guys to get to the point where you're doing something like this. Right now, this is a live picture of my our trading room, and I was just drawing out potential, just a roadmap. I'm not looking to short this. I'm just road mapping because bigger picture is giving us some ideas. But I want you to get yourself into the mindset of always looking at patterns. So if you look at our scanner one more time, the scanner is powerful in that it's always presenting us ideas to work with. So if you think about it, watch this. Okay, you see the pattern X, A, B, C, D. Don't worry about the symbol. See the pattern X, A, B, C, D. See the pattern X, A, B, C, D, A, B, C, D, X, A, B, C, D. What's happening is through the use of our scanner, you're training your eye, okay? You're training your eye to see these particular patterns. The goal is for you to continuously train your eye. Here's another one. These I have to. I gotta be honest with you. This scanner is the most powerful scanner I've ever seen in my life. I've used so many different products and free products, and oh my gosh, I just ended up hiring my program. It took us many, 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 many months and 10,000, over 10 to 15,000 lines of code to complete it, and we got a masterpiece. But quite honestly, I love our scanner. There's nothing better. It just puts ideas out for us all day long. So X, A, B, C, D. I like this. Okay, you're always training your eye. That's why I built this. We have other digits, detail information that we're not showing. We'll put it here because we want to focus, and I want you always to see the patterns. So let me give you a little advanced class on what we're expecting to see when you trade. Okay, remember X, A, so it's A, B, C, D in essence, right? What we just talked about. The other thing is, watch this. In Elliott wave, market goes up, comes down, goes up, comes down, and goes up for that third time. In the world of trading and Elliott wave, everything moves in cycles. Although you see this big pattern, well, there's more to the pattern than meets the eye, and that's what we're going to be learning. But you can't learn it all in one day either, right? So keep this in mind. You're always looking at these waves. Same here. You see the market goes up, and the market comes like this. All right, market come like that. So that right there alone was a big pattern. Within this structure, the market gave us another pattern. Okay, and then when it reversed, it made its multiple waves up. So where you're seeing harmonic patterns, there's other patterns that I'm going to be teaching you in the future that you're going to tie in together. It's going to make your trading so strong at a level that professional traders that have been in the, or not, I shouldn't even say professional traders, traders that have been in the industry much longer than you cannot compete because you see within the structure. Most people that look at harmonic trading, most people look at harmonic trading, they see this, okay? This is all they see. That's it. And they barely even understand that. When you start really understanding harmonic pattern, you're understanding waves within patterns, okay? Waves within patterns. And once you understand what part of the trend you're in, the higher time frame, you really have it all over everybody else. All right, and you'll see as time goes on what I mean. For instance, well, not for instance, we're gonna get rid of that and let's get back to the charts. And we'll go back and forth, and that way I can sit and I can explain this intelligently and give you guys a really, really good understanding, all right, of this and get you off to the races in the right direction. So this is really the first main video for the course, which you're going to have a lot of good quality information going forward. And I don't want to hit you all at one time. What would happen if I hit you all at one time with all the videos? It's going to be a mess. All right. I want you to stage out your education, start working with the education that we give you, and tighten up your game. When you really truly understand the power of harmonic trading, you'll never look at anything else ever again the rest of your life. I promise you. Once I learned this, and I've been doing this for quite some time, I've never looked back. Harmonic trading is my baby. It's my life. It's how I trade. I want to get into a little bit more the foundation of harmonics and where it came from. And that way, at least we're all on the same page. Let me just get a little sip of water. And sometimes when I speak, you hear that. Don't worry about that, okay? That's just me. That's how I am. All right. I'm not a professional speaker, but I'm a professional trader and a professional educator, and that's more important than the little details that may be in the middle of our conversation here. So let's take a little walk through trading and understanding harmonic patterns and really the foundation of them. All right, so I'm going to give you guys a little bit of information that most people do not understand because it just is what it is. When I look at the industry, most people don't understand really the foundations. All right, back in the 1990s, Larry Presavento, okay, Larry Presavento, right here, had, right there, that's Larry Presavento. And this man right here, he basically brought harmonic trading to the world. It was him and another guy, gentleman by the name of Bryce Gilmore. He's very, very big into market geometry. He's very, very big into what is called present day harmonic patterns. In the 1990s, around 96, 97, he was in, I believe it was Austin, Texas. I was actually down there at the time. I was not at this particular seminar. My mentor and former partner was at this meeting for the market technicians. And Larry, what they do with the market technicians is they teach the big gurus, the big pioneers of the industry, get up and teach. They teach for an hour or two, just like you would go to a seminar. They teach each other. And in this particular market technicians, somebody was presenting H.M. Gartley. So we're going to do H.M. Gartley, okay? All right, Gartley, H.M. Gartley. Let's see if we can find the H.M. Gartley. Let me see if I can find the original pattern. All right, and as you see, everybody in the world does this stuff here. Let me just see. Difference is we got the scanner, right? We got the scanner. We got the good education. So let me see if I could find his book. Okay, Profits in the Stock Market. All right, this is the book, Profits in the Stock Market. And let me find the exact pattern. I'm going to pause the video for a second. Okay, this is the original drawing that came in H.R. Gartley's book. Essentially, if we look at this, all right, this is what he had put. All right, you had the waves down, market went up, put a higher low, and he's basically saying on a higher low, you're buying it. What was not shown was the whole Gartley pattern, which was this. All right, market went up, market came down, market did this, market did that. All right, and then you have your pattern like that, right? So in here, what Larry had done was he looked at this, he looked at that. And in here, if we look at this, let me just make my pen a little bit smaller. Maybe my arrow, I could do my arrow, my tool. The width. Okay, here, watch this. So it came down, oh, no, that won't work. All right, we'll get it, don't worry about it. Okay, we got the width. Okay, so when Larry was at this meeting, the market technicians in MTA, what they call it in MTA in 1997. So I'm giving you guys history on this. In 1997, somebody presented H.M. Gartley's book and his contribution to the industry. So Larry saw this. He went home, he opened the book, and he saw this page, and he saw this. Okay? And he thought, wow, there it goes. That's a beautiful pattern. And he called it the Gartley 222. So that's where the original Gartley came from, was that. All right, was this, was this, was this, was this. All right, just like that, up. And he went and he did some work and he did his studying on the Gartley pattern. Oops. That he developed, and he was one that brought the Gartley to the industry. It was Larry Presavento who originally brought the Gartley. From that point, there was a gentleman by the name of Bryce Gilmore who coined the term the butterfly. The butterfly, let's see here. I'm not sure if See if we could find it. Okay, we just grab anybody's chart, it doesn't matter here. So the butterfly VX, a down, all right, down a 786, up 38.79, down a 1272. So Bryce Gilmore put this together, the butterfly, and from that point there was another person by the name of Scott Carney who, well, not him, harmonic trading, here it is. And Scott had come and put his thinking behind it, right? And everybody has their own interpretation. Scott doesn't really recognize Bryce and Larry don't, and seems Bryce, they don't recognize each other. So harmonic patterns really came from Larry Pesavento, who's a friend of mine, and he's very close with my former partner and a friend of mine, another friend of mine. Anyway, so Leslie Juvelis, her name is, and Larry works a lot with harmonic patterns. If you do research on him, I would totally suggest it. The guy's amazing. You could always look and do research. My whole thing with trading is I don't want to be the guy. You never want to be the guy. You always want to be in the learning mode and learning process. And I'm always out there learning, always, always, always. Larry and I speak at the same events. I'm speaking at the I speak at money shows. He speaks at them, and we're all basically in the same world. He has his own education. I would suggest going to his radio show. They do a lot of video work, but the point is, at least you know where the original pattern came from. Was Larry Pesavento going to the Market Technicians Association in '97 or '96, around there, and then he wrote a book from that point, and then everybody else started jumping on the bandwagon. So at least you know where the patterns came from. And let's start again. Let's look at the Gartley. Let's draw it out, and that way we're all on the same page. So we remember that we talked about having the impulse leg, and we can't have an impulse leg if it's very, very small and you can't see it, right? So let's keep the thicker pattern. Let's just call this blue. All right, so let's take from here. Market has an impulse leg up. From that point, market has its market has its impulse leg to the upside. It rallies. Now I'm going to show you the precursor to this in a bit, but I want to get the pattern down with you. Then you have a retracement of around 61%. And then the market runs up 38 to 88% of that last swing down, and then it drops one more time to about 786. So what we're looking at, and let me just take this smaller, right? So you see, there we go. That would be what's called the Gartley pattern, and we're going to call this the X point. You're always looking at X, where X starts, A, B, C, D. You're always looking at where to find D, and you're always looking at where X is the beginning. X also has a relationship to D on the whole retracement of the whole pattern. So now that you see the beginning, let's go through it again and give you a better understanding, one swing at a time. And then we could look at this maybe on a live chart if we can find one to show you. And I think we just showed you one, right? So we'll go through this one more time. Okay, so market here, we got impulse up and then impulse down. Let's stop right there. Okay, so we're going to call this the X. We're going to call this A, and this is going to be B. And this actually should be coming lower. It should be coming right around there. And this would be equivalent of 618 of the prior swing of X to A. So you have the impulse leg as we discussed, and then you have your A to B. B. All right. And then from this point, you're going to see another rally. Now what it's going to do, it's going to take A high down to B low and take the percentage back up. So it can go anywhere from a 38%, to an 88%. All right, 0.6. If you're not exact, people are going to get, what do you mean? It's not perfect. So let's go all the way up. So you can have it where it falls anywhere in this particular zone on the way back up. So meaning that the market can go 38% and then down, or it can go 88% and then down. So anywhere in the zone is acceptable for that. On the way down, at the lower area, you have your X, and now you're looking for D. Let's just say hypothetically here, let me just change this to red, that this is 618 and this is 786 right here. That this is 786 right down there. What we end up getting is color blue. What we end up getting is the market does rally, down, up, and then down again, and that forms that Gartley pattern. So hypothetically it did this, okay? And before, if you remember, we looked at the bat pattern. Remember that? We looked at the chart where it came down to a 786 zone. All right, remember that? We looked at that before. And the market went up, and I was showing you on this chart. Oops, I'm sorry about that. I was showing you on this chart earlier how the market came down in this zone. So we'll look at it one more time. Remember, impulse up, X to A to B, B to C, C to D. That was that bat pattern. The Gartley, because it goes down, first leg is 618, and this leg is a 786. Okay, so back to our chart. All right. So we want to, let's take a look and see if we can find a prior pattern that shows the Gartley. All right, let's do that. All right. Okay. So what we're going to do is I'm going to get rid of some of these things here, the jewelry on the chart that you don't need. All right. And right there. So let's take a look at this together, and we show a real example. Okay, X went to A. That was an impulse leg where the market went from low to high. That first retracement down hit that 618 retracement of the X to A. Then from B to C, it went between a 38 and 88% back up, and then down. 786% of the X to A leg went down in that zone. So that's where you have this pattern is called the Gartley. All right. And once it comes into the zone, that's where what's called the PRZ, the potential reversal zone. And you got to give that to Scott Carney. He came up with that at least. And all these guys are pioneers in the industry. I would take nothing away from them because they all have major contributions. And sometimes ego gets involved, and I'm the last person that has ego. I just more or less try to be a student of trading. And I think that's, if you stay as being a student of trading, you can become extremely successful. And that's really the goal is what you really want. So let's look at more Gartley patterns, maybe look at some stuff in the past that had happened. All right, this one didn't seem to reach the exact entry. All right, and here's one. Okay, for example, this is the NZDJPY. It's a 15-minute chart. All right, we're just going to look in the past and what had happened. Market went from low to high. That's that impulse leg. No matter what, went from low to high. And that first key retracement down gave us that 618 retracement. From that point, the market put in a lower high around 886, then dropped down again to that 786. All right, and that's where you got that Gartley type of pattern. So you want to start training your eye. I love using the scanner to do that. I want to show you something else that we discussed. All right, I want to show you something else we discussed. Remember we talked about earlier. Because it comes into the zone doesn't mean you automatically buy. Look at this. The market gave a bounce, came down, higher or low, started to turn up. You could have either bought it on the way up or waited till it surpassed this particular high and then let it go and put your stop down here. You always want to let the market stop going down before you enter as a buy. And reverse is true for a short. You want to basically always allow the market to make its turning points. So I like the fact how this looked. Low, market rallied out of the zone, came back for a higher low, and then took off, and then started to do its trading pattern. Very, very good pattern. NZD USD 4-hour chart. Let's take another look at this. All right, look at that. So Gartley pattern, X to A to B, B to C, C to D. All right, and that's where you got it. And we got that 618, then the 786, 618 of XAB. All right, well, B is 618 of XAB, and then D is 786 of X to A. So this is the basic original pattern that we want to look at. Let's take a look at other ones. All right, we'll look at the bat pattern. All right, so bat pattern, what we discussed before, I drew the chart out for you. We're not going to do another one, but I will do it on paper. X, well, that's not good right there. X down, alrighty. X down to A. First retracement B is basically 38% to 50% of the swing down. So market moved down, came up 38 to 50% of that prior swing. Anywhere in here, okay? And then the market made a 38 to 88% zone down. And then here's your completion point. And one more time, up, 886. That's your bat pattern. That's a derivative of the Gartley. The bat's a derivative of the Gartley, the shark, the all the different patterns. All right, they're derivatives of these original. I have one I call the deep bat because I just like it because of the structure that it does. And Bryce Gilmore originally said that as long as it's binding geometry, everything else falls into place. So let me continue. Let's get back to our chart and our drawing. So one more time, we know that the market structure for the Gartley is this. All right. And again, real important is that we're always looking at the A to B, C to D. Always looking at this is important right there. Right? Don't worry about all the ratios right now. That's not important just yet. We're always looking at that. Well, what a lot of traders fail to understand that, let's just say you have this downtrending market, and this has been trending down, right? It's trending down. It's just a very, very weak market. And then you have this person here, 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 here. Okay? Now, where the average person is looking at this and saying, all right, so if we took this and then we took this, okay? All right. They're both Gartleys. That's a Gartley. Okay? They're both the same, right? Gartley. Even though when you're looking at this, you're saying, okay, the impulse leg is here, got your structure. It's right. This gotta be a buy. This has to be a buy. Everything looks good. What most traders fail to understand, and I say most because I've been in the markets enough to have enough conversation with enough people, and I'm talking about even some of the pioneers in this, okay? The pioneers. I'm not going to mention any names. I love Larry Presavento. He's phenomenal. He understands this. But there's other people that pioneered the industry and other traders that trade this just do not understand it. So when you understand this, you're going to eliminate your losses in trading by tenfold. All right? Really, you're going to eliminate your losses by tenfold when you start to understand, all right, this particular part. Now, you always want to go with the trend, not against it. And yes, this looks like a pattern. And I've seen so many people think that this is the higher low. And that's it. They figured out they're going to pick the bottom. This is the pattern. And it looks good. What ends up happening is the market ends up dropping and dropping and dropping. When in fact, that this whole move down was just basically a continuation of a trend down. It was not a bullish pattern. So the market fails, and you'll see it too on our scanner. You'll see patterns fail because the scanner is picking up ideas, and you have to just look and say, okay, is it an uptrend or a downtrend? That's the simplest part of it. And it's so easy to identify. That's the funny thing. So when you're looking at the scanner, when you're looking at patterns, you want to first know, is the market in an uptrend or downtrend? Let's take a look. Let's go back to a pattern that we just had, and everybody's losing their mind with on Facebook, the excitement. Everybody's excited, right? But let's take a look. Let's really take a look at what the market is doing, and then you'll understand better why you want to do this. So let's think about this. Market's in a trend up. There is nothing saying that the market is in a trend down. You see that? Trend up. It's just a retracement in a trend. That's what you're doing. When you're looking at the Gartley pattern or looking at any harmonic pattern, you are looking at retracements in a trend, so you want to go with the trend, not against it. All right? Keep that in mind. So when you're looking at, let's just say we had this on an hourly chart or a 4-hour chart. All right? You can't really see the bigger picture. You always have to step up to that bigger picture and see where the market is. And it just lets you know, look, you're in a bigger term uptrend. Where there's patterns that fail, and I hope to find one that fails because it's kind of silly if I can't. This is comical. Okay. You ever want something and you can't find it, and I'm trying to find a failed pattern and I can't do that just yet? Okay. Regardless, let's take a look right here. All right. This is funny. All right. So let's take a look. Market's in a downtrending market, downtrending market, downtrending market. All right. So what are we basically looking at? We're looking at a downtrending market that anything that pulls back up, you want to look at the short side. You really don't want to be on the bullish side so much. All right. Would you feel comfortable selling up here or buying on the move down? You'd feel better selling moves up than buying moves down. So unfortunately, I can't find anything there. Let's try to find a failed pattern. Okay, again, big move up, corrective wave on that high time frame, getting that structural pullback. So let's go take a look once again what you really want to look for. So let's take a look. Market is moved up in price, then it's come down, then it's come up, and then it's come down. During this point, the market's been doing this. All right. Market's doing this. You're in an overall uptrending environment. And if you look at these are waves that we're going to talk about later, not now. This is what's called, we're not going to, with a little touch on it, just so it gives you a little taste. Okay. This is called Elliott wave, a 5 wave. Don't worry about going out to learn it yet. You don't need to. I'll give you all the information you need. I promise you. What you're getting $1 million education for a few $100. I promise you. You don't need to go out and get confused studying from the whole world. It's only going to confuse you. I'll keep you on the right page. Don't worry about that. Chris gotcha. All right. So let's take a look. If we look at this structure, okay, it's a bullish market. 1, 2, 3, 4, 5. After the 5 wave, we're looking for a corrective wave down. In the Elliott wave theory, all right, after the 5th wave is completed, this is considered a high or 5th wave, and that corrective wave is A, B, C. All right, this is where it becomes interesting, where you're marrying Elliott wave and harmonics together. Harmonics is actually a basis of Elliott wave. Although harmonic traders don't recognize Elliott, and Elliott wave traders don't recognize harmonics. And quite honestly, it works. I recognize both. I have no ego. All right. When I say I have no ego, if I tell you just I'm going to get you all the information, save you money, I mean it. Save you money. Don't spend it on unnecessary courses and all that stuff. We got you. All right. So if we look at this in terms of Elliott wave, all right, or then harmonics. Your 5th wave is complete, your ABC down. Essentially what we're looking at is here's your structure. All right. I should say it comes down a little bit further here. All right, like this. This would be your X. Oh, I'm sorry. X, essentially. Whoops. X, A, right? B, C, D. So, I don't want to confuse you. In Elliott wave, you have 1, 2, 3, 0, 1, 2, 3, 4, 5, or what we call 1, 2, 3, right? Then you get your A, B, C down before continuation higher. This is how it looks, all right? In the harmonic world, because you have that same structure, you have your X, A, B, C, D. The two worlds kind of merge together. The point is, where we looked earlier at a downtrending market and why patterns can fail, and more likely if you wait for a bullish market and you get a bullish pattern, then you have a much stronger move to the upside rather than trying to buy a market that's doing this and you're buying them down here trying to find the higher low. You best wait for that market to run up and find that pullback, that retracement. So harmonics are intended for what? Bullish harmonics are looking for a bullish pattern in a bullish trend. If you got a bullish trend and a bearish harmonic, more likely than not, they're going to fail. If you have this strong trending market, and then you get a sell, well, more likely than not, it can continue. You want to wait for that pullback for the buy. Just because it's up here doesn't mean it's not a buy. Trends will stay a trend until they are not, until they fail. So you're always going with the trend, not against it. So in this video, we learned, number one, what the history of harmonics are, back from Larry Pesavento found them, Bryce Gilmore introduced them. We then went forward, talked a little bit about Scott Carney, his contributions. We talked about the Gartley, we shown some examples. We talked the bat, we went through the model of what the bat and the Gartley should be, what they look like. We went through some live examples. And we basically went through why you should look at the bullish trend for a bullish pattern, bearish trend for a bearish pattern. And we took about an hour. So what we're going to do is we're going to include this as one of the modules for the course. And in the next module, we're going to expand into all the different patterns. We didn't quite get to complete them in this first hour, but the next video that we release will have all the different patterns. We'll go through them step by step because we have lots of patterns, lots to go through with you guys. So let me see if I can even find our harmonics. Here it goes. All right, so we talked about the Gartley, we talked about the bat, actually the alternate, that's the bat. In the future ones, we'll talk about the alternate bat, the crab, the butterfly, the shark. We'll get into all these different patterns and how it all interrelates with the scanner. In my opinion, the scanner is the most powerful thing to hit the market. Hands down, bar none. I built it for myself. I didn't build it to sell it. It just happened that that's how it happened. All right, our scanner is absolutely amazing. The information that it gives you is absolutely amazing. You're going to get more videos on that. But those of you that know how to trade, this is easy. All right, it's easy. It just gives you the pattern, the date, all the information that you need, and all you have to do is work out your levels, your zones to get in and out. What I love about harmonics is the fact with the scanner is the fact that you can use your own indicators to come in and trade. You can put your Bollinger Bands, you can put Keltner channels, you can put different moving averages, however you want to make it work. The beauty about it, our scanner works with everything. It's absolutely amazing. So if you find that you need to put Bollinger Bands where they're coming through like this, okay, and give you that zone, fantastic. Whatever works for you to add to the tool, fantastic. This right here is a tool. It is a tool, all right? Similar to like a hammer to smash a nail. The great thing is about this scanner that as opposed to some of these other ones out there, they're free, they may be okay, but trust me, I've been through and I saw everything. You don't need it. This right here, you're getting your trade risk, you're getting your levels, your zones, and it's continuously giving you the proper patterns, the proper ratios over and over and over. When I tell you that I'm not going to use the word extremely successful, but I am, and trading has been my life, my forte. I'm going to teach you what I learned, what I do. I'm going to teach you how to stay out of trouble. I'm going to teach you how to make a friggin' fortune, okay? Our course right here, you're going to get yourself $1 million education for a few $100. I promise you, all right? I'm going to give you guys my life, my soul, everything that you can learn, because if I make you a great trader, all right, you'll go out and you'll just build yourself a dynasty. It makes me feel good. Some of the people in the industry already are on television. They're in books. I love that. They're good friends of mine. I hope that each and every one of you become successful. You become a friend of mine and that you can teach others. It's important, and so you know that I've learned, I'm teaching you. You learn, you teach other people. It's always that pay it forward thing. All right. Trust me, we don't need to put this on the market. I do not need to put it on the market, on the contrary of what anybody would believe. So this is a dream. It's a goal. It's the fact that I can now teach you without having to physically draw it in your hand or take your hand and draw it. We're giving you the scanner, and now I can teach you how to use it. We have some other stuff that's coming that's going to blow your mind in the future. Just stick with us and rock and roll. Let's have a successful future and be looking out for the next module. My name is Christopher Terry, CEO of iMarkets Live, and rock and roll.